Hello and welcome to the Certified Local Government Virtual Summer of 2020 Training Series offered by the North Carolina State Historic Preservation Office. My name is Christy Brantley and I'm the Local Government Coordinator. Ideally, we would be bringing portions of this training series to your community, but because of COVID-19, we are offering training in a virtual format this year. At least one session per week will be released and uploaded to our North Carolina Department of Natural and Cultural Resources YouTube channel. Once a video is available, we will send out a notification with a web address through email and our North Carolina Preservation listserv. If you would like this session to be counted towards CLG training requirements for the 2020 federal year, please submit a brief summary of what you have learned to me at christy.brantley@ncdcr.gov. Please include your name, the name of the commission, and the session title in your email. A screen with my contact information will be shown at the conclusion of this presentation. Our sixth session is about historic tax credits presented by Restoration Specialist Brett Sturm. Brett joined the HPO staff in 2017 as Restoration Specialist for an 18-county area in the Central Piedmont. He holds a bachelor's degree in history from the University of North Carolina at Chapel Hill and a master's of science in historic preservation from the University of Pennsylvania, where his primary focus was the conservation of brick and terracotta. Prior to his tenure with the HPO, Brett worked as project manager for a general contracting company specializing in historic home renovations in Center City, Philadelphia. Brett is thankful to help advance preservation work in a region of the state encompassing his own native county of Mecklenburg. As restoration specialist, he provides technical assistance to local governments, private building owners, and nonprofit organizations on old building quandaries of all kinds. He also consults on and reviews building rehabilitation projects seeking federal and state tax credits, the subject of today's training. Away from architecture and history, Brett's primary passions are ceramic arts, gardening, guitar playing, and rowing. Thank you, Brett. Thank you for coming. We look forward to hearing about the historic rehabilitation tax credits.
Thanks, Christy. Okay, I'm hoping everybody can see me. It's a pleasure to join you here in a virtual format. It's not necessarily our preferred medium, as Christy said, but we're glad we can reach you nonetheless. And as always, we're very appreciative of the citizens out there who donate, their free time to participate in local historic commission service. You guys are really the foot soldiers on the ground, and we are thankful for you. So I'm going to share my screen. And you should be able to see now my presentation. Let's see here. I'm going to go full screen, and I will turn my camera off actually to hopefully make this a little bit faster in terms of internet speed. All right. So today's subject is rehabilitation tax credits. We have here at the state level a few tools that we use to promote preservation work. Chief among them are just enthusiasm and education, getting out and speaking to people on the ground and making them aware of historic resources in their neighborhood. But as you all likely know, it can be costly to own and maintain old buildings, particularly when there's been deferred maintenance, or particularly when a business plan maybe calls for a new use for an old building. And so there's a very valuable tool in our toolbox that helps promote the sensitive adaptive reuse of old buildings, and they are the rehabilitation tax credits. So let's dive in. I'm going to try to keep this presentation relatively short, understanding that it can get tiresome to sit behind a computer screen all day. So we're going to launch right in. And when I talk about the tax credits, I'm always very careful to sort of make sure folks understand what tax credits actually are. So to to define a rehabilitation tax credit, we would look at the term rehabilitation, which we define as the process of returning a property to a state of utility via repair or alteration. It's not the same as reconstruction or restoration. We understand that sometimes old buildings need to be modified to accommodate a new and profitable use. And so that's precisely what rehabilitation allows. In tax credits, we like to make sure folks understand the difference between a tax credit and a tax deduction. Tax credit is actually a dollar for dollar reduction in the amount of tax that an individual or business owes, whereas a tax deduction, of course, lowers the amount of one's income that's subject to taxation. So it's a valuable incentive, and people, usually their ears perk up when we talk about it because they realize how valuable it is. Now, in North Carolina, there are two broad tracks for this program, two different types of tax credit projects, essentially. And I'm going to talk about them separately. I'm going to start with the income producing properties. You might consider this just a commercial track, although if you have a residential property that you're renting out and deriving a profit from that, that also gets put into this pot of income producing tax credit projects. These are subject to both a federal and state tax incentive, whereas the other track, which is residential or non-income producing, is a state credit only. And I'll talk about that in the second half of this presentation. The first important question, if you're a building owner, a historic building owner, is my building eligible? And here we see great tax credit example from Hickory, North Carolina, which has done a wonderful job utilizing some of its old mill properties. How do we know if a building is eligible for credits? Well, it has to be what we call, quote, certified historic structure. And that means that it is listed individually as a single property in the National Register of Historic Places, or it's located within a National Register Historic District and is designated as a contributing property to that district's historic character. How do you know? How can you find this out? There are a couple different ways. You can get in touch with us and we can check for you. You can also check out our online mapping portal called SHPO Web. And whenever I have a chance to speak to the public, I like to make folks aware of this tool because it's useful for a lot of different reasons. So there's the web address for SHPO Web. You can also just Google SHPO Web North Carolina. It should take you there. This is what it looks like. You see our state populated with all these different colors, dots and squares and outlines of neighborhoods and districts. Basically, this maps every single National Register listed property or district in the state. And you can use this portal to enter your address and check to see if indeed your building is located in a district or if it's individually listed on the National Register. It will also tell you actually if your building is within a local historic district or if it's locally landmarked, which is a designation that applies more directly, in fact, to the work of local commissions. So here we have the example of Newton, North Carolina in Catawba County. And I've zoomed in here and taken a screenshot. You can see that Newton has two National Register historic districts, those larger blue shaded areas, as well as a couple individually listed properties. So look up your hometown and see what you find. And what you can do actually is take your cursor and click on one of these. Here, you should be able to see my cursor. You can literally click on the outline of a district and a little pop-up window will come up like that, which gives you the opportunity to access the PDF document of the nomination. Now, every National Register nomination has a property inventory listing every single address located within that district. And so this actually is the nomination document for a district in Gastonia, the Yorkchester National Register District. And you can find, let's say that you own a house and you live in that district. You want to know if your house is contributing. Well, open up that document. I usually do Control F to search that document. And every nomination is indexed. and I'll type in the address, and it will take me to the location within the inventory where that address is featured. There'll be a little description of the property as it was at the time of the district's inception listing. And then you'll see this designation here, contributing. Sometimes you'll see non-contributing. For instance, if a building has been dramatically altered, or if it was built much later after the remainder of the district was built, for example. So find the property in question and see what this designation is. And I've dropped these little check marks here to indicate that all 5 of the buildings listed on this particular page, on this inventory, are indeed contributing. So they would be eligible for the program. Now, to dive deeper into the commercial side of the tax credit world, income producing projects, they come in all shapes and sizes. We see commercial downtown buildings, your average sort of 2-story Main Street structure. We see mills, of course. North Carolina has a rich heritage for textile and furniture making. Lots of mills have come through, tobacco mills, of course, in cities like Durham and Winston-Salem. We see rental housing, as I mentioned before, and we also see agricultural properties, including this project, which is really outstanding, the Winmock Barn in Davie County. Let's talk about the mechanics of the credit. How does this thing work? Well, as I said, for income producing properties, it's a joint state and federal incentive. So it affects both your federal tax return and your state income tax return. Now, if you do a commercial rehabilitation and you go through the process, you can claim a state tax credit that is equal to 15% of the project's qualified rehabilitation expenditures. We call these QREs, and a future slide will detail a little bit more what we mean by QREs. That's the state side of the credit. This piggybacks, so to speak, onto the federal credit, which is a little bit more robust even. 20%, it's equal to 20% of your project's qualified rehabilitation expenditures. The state credit, I should mention, can be enhanced. There's 2 different bonuses that can come into play to enhance and augment that state credit. There's a 5% development tier bonus for projects which occur in Tier 1 or Tier 2 counties as designated by the North Carolina Department of Commerce. And then there's also a 5% targeted investment bonus, which is targeted towards properties of a manufacturing or agricultural use or heritage, so to speak, that have been mostly vacant for the past few years preceding the rehabilitation. So that little extra bonus is meant to incentivize projects occurring for industrial or agricultural properties. Okay, so here we're looking at the 2018 version of North Carolina Commerce's county tier designation. So you can pull up the current map on Commerce's website and check to see which tier rating applies to your county. So let's see how the mechanics of the credit would be applied to a hypothetical scenario so you can better understand this. Here is a old furniture showroom in Mount Holly, North Carolina, in Mount Holly's downtown National Register Historic District. So let's imagine you own this building and you invested $1 million in qualified rehabilitation expenditures to bring it into a new use. So remember, the federal credit is equal to 20% of those QREs. And so that would result in a $200,000 federal income tax credit that you could claim over actually 20 successive years of federal income tax returns. And on the state side, remember that baseline state credit is 15%. So that would equal $150,000 in a state income tax credit that could be claimed in 9 successive years of state income tax returns. Of course, then we have those bonuses to consider on the state end of things. And at the time I did this slide, Gaston County, I believe, was a Tier 2 county. And so this hypothetical scenario would be subject to that development tier bonus. So add an extra 5%, that equals another 50 grand in state income tax credits. So wow, that's A $1 million project, that's $400,000 in tax credits, 40% of the total project cost that could be claimed as tax credits. That's a big number. You might be asking, well, do I have to spend $1 million to qualify for this thing? No. So the rehabilitation must be what the IRS calls a substantial rehabilitation. That means that the QREs must exceed the building's adjusted basis value within a 24-month construction period. An adjusted basis is something that applicants need to determine on their own, usually in consultation with their accountant or a tax professional. We're not allowed really to, we're not encouraged to comment or allowed to comment on personal tax situations or advice. And so, we're architectural people and we're historians. And so we're really here to help on that end. So generally we'll suggest people, confer with their accountant, determine their adjusted basis value for the building in question. And then that becomes essentially the minimum spending amount that they need to exceed during the rehabilitation. And, you get a 24-month construction period to rack up those costs. Generally speaking, I'll say, however, that the adjusted basis, what we're really trying to figure out is the value of the bricks and mortar of the building itself. And so IRS is interested in knowing that value and knowing that you essentially doubled that value by spending the equivalent of that value during your rehabilitation. And so people will generally calculate that by taking the purchase price of the property plus any capital improvements they've already made, and they'll subtract from that the assessed land value and any depreciation they've already claimed to get sort of that idea of the value of the building itself. Again, talk to your accountant when trying to determine that value. So again, QREs, what do we mean by that? They can encompass both hard and soft rehabilitation costs. So hard costs are, actual procedures and material used in the construction work. So that can be anything from rough carpentry to insulation to doors and windows to your finished flooring or tile to your ductwork, electrical and plumbing costs. Soft costs are incurred through consultants fees, engineering fees, architects fees, permit fees, for example. Important to note that QREs exclude a couple different things. They exclude, for instance, the cost of the property when you acquire it. They also include most site work costs, including hardscape and landscaping costs. They exclude any work pertaining to new additions. That's not to say that a tax credit project can't feature an addition, but you need to be careful to isolate in all your cost tracking measures any costs pertaining to that new construction, because again, the credit is really geared towards the rehabilitation of historic properties. And of course, you can't claim personal property like furniture or appliances. So just to give a couple examples of applicable QREs, here I show a photo of the Windmock barn from the previous slide in Davie County. Look at all the timber, look at all the lumber involved in this building. Let's say you had a couple of rotten sills or rafter tails or something like that. Anything pertaining to that structure, rough carpentry, framing, etc., obviously a QRE, so I've got a little check mark there. Demolition is a good example of a QRE, and this is an interesting case from Wingate, North Carolina, where an intrepid applicant saw this sort of two-bay structure and said, I wonder what's behind that aluminum siding. And so they went on a limb and took that siding down, found a relatively intact historic facade, stucco on brick behind that, and restored that facade as part of a tax credit project, and then could claim the demolition costs as a credit. So we give that a check mark. This is a wonderful tax credit project out of Winston-Salem, but I have an X on it in the sense that this part of the building here is an addition. And so you have QREs being racked up on the rehab of the historic warehouse structure itself, but any cost pertaining to the new addition could not be considered qualified. And so again, you need to Applicants need to be really careful on addition projects and isolating costs, and not only hard costs, but engineering, design, anything pertaining to this building, and isolating that from the old building, because those would not be qualified. So, we'll often say in the field, you don't simply get a tax credit for owning and working on an old building. Your rehabilitation project has to be certified, and it's certified through a joint review from our office and the National Park Service in Washington. And we use the Secretary of the Interior Standards for Rehabilitation to certify projects. If you're not already familiar with these, with the standards, you will be soon. My counterpart, our Western office, Jennifer Cathy, recorded a great training session going in depth with the Secretary of the Interior Standards. I'm just going to talk about them briefly here, but they are our review standards for this particular program, both on the commercial end and on the residential state end. How do you claim the credit? Let's see. Well, you can begin claiming the credit the year that the building is, quote, placed into service, provided that you've gone through the process and the rehabilitation has been certified by both our office and the National Park Service. At that point, again, the state credits can be applied to to returns over as many as 9 years. The federal credit can be applied ex post facto by 1 year, into the past onto a past return, and on as many as 20 years into the future. So it depends on an individual or a business's tax liability, how they claim the credit. Again, something you want to talk with your accountant about before you embark on this process. You want to make sure that you can, that the credit will be useful to you, depending on your own particular tax situation. There was one change late in 2017 that's worth noting. That is that the federal credit actually can't be claimed all in 1 year, as sometimes will happen on large-scale commercial projects. Now that federal credit must be applied over a minimum of 5 years. So that's something that's been, this had a bit of an impact, at least on the larger projects. Application process, it happens in 3 parts. There's a part 1, which actually sort of determines whether or not your building is eligible as a quote unquote certified historic structure. Also, as part of the part 1 process, you take and submit photographs of the property before rehabilitation. That gives us sort of a baseline look at how things were prior to work being done. That's very, very important. Part 2 is probably the most homework in terms of the applicant workload. That's the description of the rehabilitation. So that involves a narrative of your scope of work, writing out exactly what you're going to do to the property. And it doesn't require, but it often entails the submission of construction documents, building plans, so on and so forth. Particularly on larger projects, that's really quite necessary in order for us and our counterparts in the National Park Service to be able to understand what you're proposing and review your proposal against the Secretary of the Interior Standards. Part 3 is typically the most fun part of the process, where all the hard work is done, and you take your beautiful after photographs and you submit those so that we can verify that you built what you said you were going to build in the part 2. And we often enjoy getting those photographs because we can go back and look at the part 1 photographs and see the dramatic transformation that the rehabilitation has had. So a couple important contacts for you during this process. The restoration specialists like me, if you're in my particular jurisdiction, or like Jennifer or Reed or any of the others, there's 6 of us across the state. We are sort of your first point of contact in terms of figuring out if the building's eligible, taking sort of a early look at your conceptual plans and giving you an idea of how they, where you might run into problems with the standards and how can that be ameliorated early in the process. That's a great conversation to have early if possible. Although sometimes we do encounter projects that are mid-construction when the applicant figures out about the credits, and so that's not unheard of. Another important person for you to know is Tim Simmons, who coordinates the income producing credit across the state. So his job is really to take the 6 of us and the different languages we speak and our different interpretations of the standards. And Tim sort of makes that uniform so that everyone across the state is receiving essentially the same type of service. Tim has also been coordinating this project since 1990, and so he has sort of a 6th sense on how the National Park Service Washington will review projects. Very valuable and good person to work with in our office. Just a couple slides about the standards. There are 10 of them, coincidentally, and so I like to sort of jokingly refer to them as the 10 commandments for historic preservation. And although Jennifer goes into great detail in her presentation about the standards, I do like to give folks sort of the Cliff Notes version of what they dictate, so that you have a rough idea of what they are. I always include a picture of Hippocrates, the early Greek physician, because you might be familiar with the Hippocratic Oath in medicine. Do no harm. First, do no harm. That applies here to the standards as well. First, do no harm with your project to the building. That is, don't take a sandblaster to 18th century brick. That's a great example. I'm sure Jennifer has more that she brings up in her good talk. Other important concepts in the standards: know the resource, understand its history and therefore its significance, so that you can identify and protect the architectural elements of the building that communicate that history and that significance. It's really important. Know a little bit about what the building was and how it was used. That's going to inform your thinking about how you might change it as part of a rehabilitation. Always sort of work backwards with an old building, not against it. So don't try to impose a non-compatible new use onto an old building. Look at what the building is inherently based on its form and its components and how it's built, and try to think of a new use that will jive well with that. Again, rehabilitation, however, is not the same as reconstruction or restoration. So accommodating change is part of the process, and that's allowed for to an extent in the standards. Finally, I like to talk about modesty and reversibility when we're working on old buildings. We are all stewards of historic buildings. There are people before us, and hopefully there will be people behind us who also own these buildings and also take care of them and use them, put them to use. And so think about that next person when you're planning a project. If you're going to do something dramatic, like perhaps an addition, think about how that addition could be reversible in the future. If someone wanted to maybe take that off and still have at the core a historic property that they could put to new use. So those are 2 important concepts too. This is the fun part of the talk where I go through some great case studies from across the state. And we see tax credit projects in a lot of different sectors. And so on the largest scale, we see industrial buildings that are put to new use. I mentioned Winston-Salem and its tobacco heritage earlier in the talk. Although Forsyth County is out of my service territory, I'm familiar with the long line of great and large-scale projects in downtown Winston that have put a lot of the old RJR infrastructure to new use. And so here we see Building 91 with its wonderful prismatic glass facades. Really great tax credit project from 2016. I believe that's now a biomedical research facility. And then one of my personal favorites from my service district, Randolph County, Ashboro, the Ashboro hosiery mills, which were converted, like many textile mills, to residential use in 2013. We see a lot of tax credit projects in the hospitality sector, hotels, restaurants, et cetera, et cetera. On the top is the mid-century Jack Tar Motor Lodge in Durham, which has been turned into a boutique hotel called Unscripted. It's very popular, really interesting building. And on the bottom, we see a sweet little store building from Asheville, the old Baird store, which was converted to restaurant use in 2015. I've actually never been. I've been by it, haven't eaten there. I'd love to go there someday. And then we see a variety of small little interesting projects like let's see, on the top, we have the Nash Street Candy Store in Southport, Brunswick County in 2013 transformation. And then a tiny little Armanda Johnson house in Edenton. That was I believe that's a rental property that was done in 2017. And then sort of your more common, I want to say run of the mill, but that doesn't do this building credit for the interesting little detailing. The Brothers building in Elizabeth City, 2-story downtown commercial building done in 2018. And you'll notice that that building had a non-historic storefront that the applicant took out and put in a more traditional storefront, more appropriate to the building's vintage. So that was a great project in Elizabeth City. We're going to transition now to the state-only non-income producing track, also known as the homeowner credit in our own little office vernacular. So this applies to owner-occupied residents that are certified historic. Remember, that means individually listed on the register or contributing within a district. These structures do not generate income and are non-depreciable. So that means that they are owner-occupied primary residences. That means freestanding houses or condos. And they are subject to the 15% baseline state income tax credit with a minimum spending amount of $10,000 and a maximum of $150,000. So you can do a home restoration where budget exceeds 150K, but the credit maxes out at that amount. And so if you think of 15% of 150,000, you arrive at $22,500. That's the maximum credit possible under this particular program. There is no federal equivalent. So it's a state-only tax credit. I believe North Carolina is one of 34 states with a residential program of this sort. Of course, some states don't even have an income tax credit. So anyway, similar rules apply in the non-income track as the income-producing track in terms of QREs and the certification process. So again, we're looking at hard and soft costs, but those that pertain to the existing historic structure. So that excludes addition costs pertaining to building of additions, site work, personal property, et cetera, et cetera. I mentioned the minimum spending amount, $10,000, also 24-month construction window here. That doesn't mean you have to finish within 24 months. It does mean, however, that when you're going to calculate your costs that you're hoping to claim against the credit, you need to isolate a consecutive 24-month period within the longer construction timeline. So generally speaking, if someone does a 3-year rehab on a house or a commercial building, they will be strategic and select the 24-month period where the majority of their costs were incurred. Again, the certification process is the same insofar that we use the Secretary of the Interior standards to review a project. However, because this is a state-only track, we keep the review in our office. It does not go to the Park Service in Washington. It's a state-only review. Again, another little hypothetical scenario here. This is a house in the Myers Park National Register District in Charlotte. So let's imagine you did a $200,000 rehabilitation on this wonderful Italianate house. Recall that the credit caps off at 150K. So you would in this situation be maxing out the credit at $22,500. And obviously, you would be meeting that minimum spending amount of $10,000. The application process is a little bit simpler for this credit than for the income producing credit. It's just a 2-part process, parts A and B. Part A is a description of your rehabilitation in narrative form. Applicants will also include drawings if their projects are more complicated. We encourage that. Sometimes we require that based on the scope. Also, as part of the Part A, you submit those before photographs showing what the house looked like before you started working. Part B then is the fun part where you're done with all the stress and the heartache of construction and you submit the gleaming set of after photographs so we can marvel and drool over. Just kidding. We just like to, see that A, you built what you said you were going to build in part A, and B, that those changes meet the standards. The contact here, aside from your restoration specialist assigned to your county, is a fellow named David Christianberry, who's been coordinating this program. Like Tim coordinates the income producing side, and David has been around, I believe, since 1998. So he's got a lot of experience with working with homeowners around the state. There are a few limitations that you want to take note of with this program. Taxpayers are limited to one project per any 5-year period. This occasionally will come up when people participate and they have a good experience, and maybe 4 years later they find that they want to replace their roof, but you did a project just 4 years prior, you need to wait 1 more year. So that has actually, even in my 3 years thus far with the SHPO, that very situation has come up. So one project per any 5-year period. The credits can be transferred with the sale of a home, provided the sale occurs before the rehab is complete, which doesn't really happen all that often. Please remember that the IRS and/or the North Carolina Department of Revenue administer the tax and finance side of these programs. And so you want to consult with these folks and/or your own professional tax advisor for help in determining the implications on your own tax situation. If you have old building questions or architectural questions, we are your people. But again, we're not experts in tax law. So a couple examples around the state of this particular non-income program at work. We find that the program is really effective for rural properties that are either in rural districts or individually listed. And here are 2 great examples from Glencoe, North Carolina, with some wonderful old mill houses, and a rural Johnston County farmhouse that had a dramatic transformation, as you can see from those photos. I like to give a little bit of tax credit trivia when I talk about the program so people can sort of understand the impact of these incentives. So in 1998, North Carolina devised its own state income tax credit that would augment that federal credit on the commercial side. And that was also the first year that the residential credit came into existence. Following that move by the state, the activity in these programs increased dramatically. So you can see from 1976 to 97, there were 670 commercial projects in the state. Now, 1976 was the first year that the federal credit really came into effect. 670 projects. During the period from 98 to 2016, when the state had its own augmenting credit, that number ballooned up to almost 3,000 projects. So you can see the real impact of that North Carolina credit. North Carolina is we were number 4 in the nation, the number of completed and certified rehab projects from 03 to 12. I think at the current moment, we're right around number 6. And so we see a lot of activity in this, and we're proud of that. When I think about, now this project happened before my time, obviously I started in 2017, but going through all the befores and after, this particular one from Mebane, the White Brothers Furniture Company, is to me maybe one of the most dramatic transformations. And so I like to show this photo just in, I get a lot of oohs and ahs from this when I'm able to present in front of audiences. That's the end of this presentation. I could have gone in a little bit more detail on certain things. And of course, there's the standards to consider too. I encourage you to look at Jennifer's presentation, as that's really the companion to this talk. But this gives you sort of a crash course in the basics. You see there my contact information. Please get in touch with me if you have any questions. If I'm not your restoration specialist in your particular county, you can also still reach out to me. I'd be glad to connect you either to Tim or to the restoration specialist in your territory. But again, I appreciate your attention. I see I clocked in a little bit over 30 minutes. I apologize for that, but Hope this has been useful for you, and we'll hope to hear from you soon on a future project in your neighborhood.
Thanks, Brett. That was very informative. And if I was unmuted, you would have heard me ooh and ah over the Mebane photograph. I had not seen that. I'd heard about it, but had not seen the actual photograph. So great presentation, some very important information you shared, and just a fantastic resource for us. And so I really appreciate it. This concludes our 6th session of the CLG virtual training series. We plan to release a new session next week, and we'll notify you once it's uploaded to our YouTube channel. And also the session that Brett was referring to about the standards by our colleague Jennifer Cathy, that should already be on our YouTube channel. So I would encourage you as well to, if you have not seen that, to watch that. It will be very helpful, and it is a good companion piece to Brett's tax credits. Remember, if you want to receive CLG training credit, to email a brief summary to me. My address is on the screen, and include the session name and the commission you're with. Also, we really welcome any feedback, so please feel free to email us with any questions or comments. Thank you for joining us.